This is the countdown to the open. I'm Matt Miller, moments away from the start of trading on a day when everybody is looking forward to the closing bell because NVIDIA earnings come out then. Today, we have futures mixed ahead of the opening bell after another fresh record high on the S&P 500 yesterday. Let's take a look at some of the other assets we're following for you this morning. Other than stocks, the euro right now trading at 108.39, the 10-year at 4.44, and NYMEX crude down another dollar at $77.70. One stock to watch at the open this morning came out with its earnings before the bell. Target, sales declining again for the retailer as it remains cautious about discretionary spending. Abigail Doolittle has more on this. Abby, what is it, the fourth consecutive quarterly drop for sales?
Yes, it is, Matt, and it's, investors clearly not liking it with this stock down at this point 10%, the worst day since November of 2022. But it's interesting because the last 5 quarters into this quarter, the stock had a positive reaction. So this is the first time that we're seeing a decline in 6 quarters after results, and it had to do with that adjusted earnings miss. And to your point on sales, comp sales declined 3.7% for the quarter through early May. Now, this was in line. Most analysts are saying that this is in line, but the color coming from the company, as you know, talking about a little bit of weakness relative to home items along with appliances, really weighing on the shares, especially also given the report, the recent report last week from Walmart, where a lot of folks were flocking to Walmart for their deals, not really hearing about that around Target. So at this point, the stock down 9.7%. Investors really not liking these results at all. That Target feeling gone.
Even the frequency high frequency categories like grocery shopping dipped during the last quarter, and that's typically where you see like a Walmart continue to do well. So have you been to Target lately?
You know, it's funny, Matt. I have not been in a Target recently, and I used to go quite frankly. Part of that might be being in the city, but I was recently near a Target, and I did not have the feeling to go in. So perhaps other U.S. consumers are feeling the same way.
All right. We always like to know the anecdotal. Abby, thanks very much. Abigail Doolittle there on Target. Watch retailers today. We're going to stick with them. TJX boosting its annual profit forecast. Urban Outfitters topping sales estimates, but shares of those edging lower at the moment as well. Simone Foxman joins us with a roundup of the retailers. Simone?
Yeah, Matt, we're trying to get a sense of exactly what is happening to the consumer and sort of a mixed picture in some of these earnings coming out today. TJ Maxx shares set for potentially their highest close ever after kind of a mixed report here, raising its profit guidance for the fiscal year, but seeing comparable sales that were slightly lower than analyst expectations, up 3% year on year. The estimate was 3.4%, and the sales projections for the fiscal year also slightly light, just slightly under expectations. For Urban Outfitters, we're seeing shares sinking as another set of mixed results, these for different reasons. Anthropologie and Free People sales, comp sales up double digits on a year-on-year basis, but still a lot of concerns about the namesake Urban Outfitters brand. Although those were able to offset in this particular quarter, it wasn't the results everyone was hoping for. We did get a few signs here about what is next. TJX talking about a good start to the second quarter. Urban Outfitters mentioning that consumer demand was robust for spring and summer. But I think there's also a cautionary tale here coming out of the likes of Lululemon. This had really been the darling last year when shares rose about 60%, but now we're watching a pretty steep decline there after the company's chief product officer set to leave and not be replaced. We get first quarter results out June 5th, but perhaps a suggestion here that spark, that extra uniqueness is really what's needed to gain an edge in this market. And now we're looking at shares down over 40% this year, Matt.
I don't know why you need a chief product officer. It's just super tight yoga pants, right? Is that not all they do?
Hey, there's something special about the way those yoga pants fit, and they've really been able to dominate that. I mean, I love Lululemon. I have their products. They're really special. Can they keep doing it without that chief product officer? I don't know.
I guess that's the issue. Simone, thanks very much. Simone Foxman there on some more retailers that we're watching in today's trade. Let's turn, though, now to electric vehicles. Tesla losing ground in Europe with sales slumping to a 15-month low. A sluggish start to the second quarter for Elon Musk. They're still making a ton of vehicles. Ed, are they selling all of them? Ed Ludlow joining us, from Bloomberg Technology.
not selling as many at the start of the second quarter in Europe as they have done in recent quarters and years. Stock's down more than 2%. It's the biggest points drag on the NASDAQ 100 after the open. It's based on data from the Automobile Manufacturers Association in Europe. So they registered just shy of 14,000 new EVs in Europe in the month of April. That is the lowest level since January of 2023. So you have to go back some distance. You remember also the context that on the most recent earnings call, Elon Musk said that going into the second quarter and the rest of the year, all of the challenges of the first quarter, higher rates, competition from plug-in hybrids, was starting to ease a little bit. Well, the data doesn't necessarily show that. Europe is facing all of the kind of same things in the EV market that we have here in North America. Leading Nordic countries have really scaled back on the incentives. While there are many more models on offer on continental Europe at different price points, you do see names like Volkswagen pivot as well to plug-in hybrids, much like some of the OEMs in America are doing. And so you have a direct competition now between BEV and plug-in hybrid, and that does seem to be impacting registrations. So this is one data point in time, but it's worth paying attention to and extrapolating over the course of the year as we track the market incumbent Tesla.
Does Europe have the threat of a Chinese EV? I mean, we have essentially limited that threat here in the U.S. with massive protectionist tariffs. In Europe, is it possible that BYD could sell its $10,000 Seagull?
Yeah, much more possible. And, if you think about the conversation on some of the names like BYD or NIO, NIO has a limited footprint in continental Europe. One thing I was reflecting on recently as well is like when the Biden administration almost quadrupled the tariffs on Chinese-built EVs in this country, I was like, well, how many Chinese-built EVs can you actually buy in America? The answer is like there's only 4 models in very small volumes, but Polestar, as an example, manufactures its cars in Europe. There is, again, a much more domestic industry in Europe where the OEMs, particularly the Germans, but also the French, right, offer a number of EVs that we have no visibility on. And so they have a much more competitive market anyway, meaning that the attraction of a Chinese-built or a Chinese model EV is not sort of the same threat that perhaps it is here in this country.
Ed, thanks very much. Ed Ludlow there, anchors Bloomberg Technology. Definitely tune into that program every day at 11 a.m. Turning now to the housing market and home builders, specifically Toll Brothers, raising its full-year outlook as the luxury builder reported stronger than expected orders. Katie Greifeld is here with more on Toll Brothers. Katie?
Matt, home builders are still high. You can see that in these results from Toll Brothers. Interestingly, the stock is lower right now. We're going to get to that in a minute, but let's go through some of the numbers right now, because for the 3 months through April, you had purchase contracts rising 30% from the same period a year earlier, managing to slightly beat estimates. Then you take a look at the outlook, and you had Toll Brothers boosting its full-year fiscal deliveries guidance between 10,400 to 10,800. That is up from their previous forecast from 10,000 to 10,500 units. So when you think about Toll Brothers, they often cater to more affluent buyers who are more likely to be paying in cash. And you think about the effect of higher interest rates, that means that Toll Brothers' demand is a little bit insulated from that. The company also said that in addition to that profile, its strategy of including, quote, more affordable luxury properties and also boosting its supply of spec homes is helping to increase its market share. And actually on the call just a few minutes ago, you had executives saying that 50% of sales are spec homes right now, actually, and that the long-term average for specs will be 40 to 50%. So a really interesting dynamic developing there. And just quickly on shares, currently down about 3%. Citi did note that you had lower inventory turns rather, and higher debt levels relative to their peers. But it's important to note that the shares are about 100% higher over the past year. So definitely a high bar there.
Absolutely. Katie, thanks very much for that. Katie Greifeld is going to go into the other studio, and she's going to anchor the Baby 10 in just about 20 minutes from now. Joining us to talk about markets further is Eric Friedman, CIO of U.S. Bank Asset Management Group, the asset management arm of the 5th biggest bank in America. Eric, great to have you here with us. Let me ask you, first of all, about how important NVIDIA earnings are. Is it right for us to be so focused on this one company amidst this, massive bull market?
Yeah, man, I think it is important to be focused on it. If you look at the ecosystem, if you will, everything from the previous segment, you emphasized utilities, you talked about the business to business trends within technology spend. That's really been a theme, a very durable theme for the last couple of years, and we still think there's legs to it. So if you think about whether it's that company with 20% of its sales to one captive customer, again, that probably broadens out over time. But that just speaks to how much demand there is for that technology. So we do think it's right to focus on it. There's, of course, a lot of other things happening in the world, but it's clear the focus for the day.
In terms of the broadening of the market, how quickly do you see that happening? Where do you see the most evidence of broadening out from the Magnificent Seven?
Yeah, man, I think it's something, you and I are both Grateful Dead fans, and it's like, that great song, The 11. There are actually 11 subsectors of the S&P 500 now participating in the uptrend, which is a good thing. So to your point, there's some level of diminishing activity across lower income consumers. We have to really pay attention to that. A lot of the chatter we're hearing from retailers, again, earnings this morning, also some of the overnight action in Europe and Asia, does suggest that at the margin we're seeing some slowdown of the marginal consumer spend. So we have to pay attention to that. We also have to keep in mind, though, that this economic growth is still really on the back of still positive wages versus inflation. It probably doesn't feel that way to most consumers, but real wage growth is still positive. Should we see that reverse, we get more concerned. We think that probably, dampens, if you will, the 11 broadening out. But for now, we still think there's momentum. We still think there's an opportunity for consumers to keep spending. And that business to business tech spend theme, we think endures.
I'm glad you mentioned the dead because it brings up another one of the big issues for this market, and that is inflation. Tickets to see them at the Sphere, I'm seeing $1,000 prices. Fish tickets were even more. How concerned are you about the lack of disinflation and the resultant lack of Fed cuts?
Yeah, I think, the Sphere recreated Barton Hall from Cornell University, which is a pretty tough ticket not to purchase. So that's probably a little idiosyncratic. But to your point, Matt, this is an environment where inflation and price pressures continue to be an issue. You're starting to see some pushback on that, though. Think about what you've heard from retailers and the clear bias from consumers seeking more value in their day-to-day living, but perhaps are willing to pay up for experiences. That's a theme that we think continues. Again, it's not just the revenge travel coming out of COVID, but people do want to live in the moment. People do want to pay up, if you will, for travel. Again, we have to see how, in fact, what kind of staying power that theme has, but that is something that divergence between day-to-day living versus the more experiential base that people are willing to pay up for, we still think that works. So, obviously the Fed and what happens with the back half of this year with the political landscape clearly in focus, but for now, we still think this is a decent environment for consumer spend.
I definitely need a miracle to get down to Las Vegas. Eric Friedman, what are you doing in your portfolios at U.S. Bank Asset Management right now? I mean, you're moving some big money around, right? $400, $500, $600 billion. Where are you focused?
Yeah, the biggest thing that we have on right now incrementally is that in April, during what I guess we can't really call it a massive dip, Matt, but there was still some level of a downturn in both equity prices and commodities. We actually bought that dip. And so we do think that the commodity bias towards upside surprises is still there. Clearly, days like today when crude's off, that does, we think, represent likely a buying opportunity. But we think that China in particular, as a export-laden economy, they're trying to run the old playbook of obviously pushing exports out as fast as they can. That will be inflationary. We think that if there is a push towards tariffs, that will also be inflationary. We also think that, again, with respect to the consumer demand trends, with some upside risk to things like hydrocarbons and also things, Matt, that you just don't get in corporate earnings. If you want to get exposure to a broadening basket of commodities, you're generally not going to get that in the corporate earnings sphere. So we think owning commodities makes sense on more of a tactical basis. We also think that equal-weighted S&P, which has been the, let's call it the lagging stepchild of the market for some time, we think it's time to get involved. There's a decent inherent yield in that category, but also you have less refinancing risk. Small cap companies in a rising interest rate environment, if we do get that risk upside to rates, will have a trouble refinancing. And so we think that owning equal-weighted S&P is a good way for clients to get exposure to the large cap equity space in the U.S. market.
Eric, great having you on the program. Thanks so much for joining us. Eric Friedman there from U.S. Bank Asset Management, coming to us out of Chapel Hill. Coming up, preparing private equity for higher rates.
A lot of firms prepared themselves for higher interest rates by terming out their debt during the pandemic. The sensitivity is just not what it used to be, and that means that it needs more time before we achieve the goal.
We're going to discuss next with Pierre-Antoine de Salency of 17 Capital, private credit versus syndicated loans. This is Bloomberg. Joining us now is Pierre-Antoine de Salency, co-founder and managing partner of 17 Capital, a private credit manager specializing in loans to private equity, net asset value financing. Great to have you here, Pierre-Antoine. Thanks so much for joining us. Tell us about the market that you're in, because even though we talk about private equity here a lot, I've been to Super Return a bunch of times in Berlin. I haven't heard the term NAV loans very often. So what exactly is is it?
So net asset value loans are loans to investors in private equity. And by and large, these are the funds that hold companies and the managers of these funds. And they use leverage to improve performance for their investors.
And how big has that market gotten now? I mean, it's not a very old market.
No, it's a market that started 15 years ago and that really started to increase exponentially in the last 3-4 years. And looking at a market that's potentially 100 billion and growing to 700 billion in the next 7 years. The entire private equity industry and the buyout market is $2.8 trillion of net asset value. That's the value reported to investors every quarter. So that's a deep market. There's a lot of room for growth for the leverage on that specific market.
So, last year private equity was a big story, mainly because of the private credit aspect coming into a lot of those firms. Now banks have really come back with lending for leveraged buyouts. How do leveraged buyouts look to you in 2024?
I think these are really exciting times. If you look at the way the market, the private equity industry developed over the last 10 years, it's been a very exciting environment because the interest rates were very low. And now the environment is a bit more difficult, a bit more complicated. And you see the difference between the good operators and those who are only benefiting from the environment. So you can separate, the good from the weak ones. And people have to focus a lot more on being efficient on the operations point of view, making the companies better. So it's really an exciting time for the private equity industry.
I mean, I would expect, as interest rates rise, that leveraged loans would be harder to get, more expensive, more difficult to make money on, and yet, there's so many trillions of dollars in private equity. Has that number grown this year?
So the volume of leveraged loan issued in the first quarter is more than half of the whole of last year. So you see confidence coming back. But yes, the higher...
More than half of the entirety of last year in the first quarter alone.
Yes. So big return of confidence. I think it's just making the job of private equity investors a bit more difficult, which is also making it more interesting. As an investor, you have to choose where you're going to, as an investor in private equity funds, you have probably between 1,800 and 1,900 funds open for you to invest in any day of the week. And you need to choose the best managers, and then you sign with them for another 10 to 12 years. So the industry is under a lot of pressure to do the right thing and provide the better returns for the investors. But it's more difficult today than it was 5 years ago.
Where do you see the biggest opportunity, the best opportunities? I mean, if you're looking at the U.S. or Europe or Asia, are there spots that look more attractive?
Well, we definitely see more appetite in the U.S. and more confidence in this part of the world. And then you have some sectors which continue to thrive. I'm thinking specifically about of software and the healthcare industry, which attract a lot of capital these days.
What about artificial intelligence? I have to ask because today we get NVIDIA earnings, and if you look at the chart of NVIDIA or a lot of AI, I looked at super microcomputer today, and it was like a hockey stick. So is AI huge as well in your business?
I think in our business, not quite yet. I think there's a lot of people looking at what it could be and what value it could bring to investors. But I think we operate in a buyout space. More than the venture capital or the growth space. And in the buyout, I think a lot of companies are looking at it, looking at how they could create more value for the shareholders, but it's still at curiosity level and more than implementation.
And how much does the Fed matter to you? I mean, rates apparently don't have as much of an effect as I would have thought, right? We're a lot higher than we were 2 years ago. Does it matter if they cut once or twice? Does it matter if they even raise once?
It matters usually because it changes the cost of capital for people buying private companies. So it matters usually, and it's going to impact the value of the privately held companies. It's going to impact their liquidity, how easy it is to sell them or buy new ones. So it's a huge impact on the industry.
But it's clearly not holding back leveraged loans if the volume is in the first quarter already more than half of what it was last year.
Yeah, it's coming back. Last year was a substantially lower number than the previous year. So it is coming back, which is good. We see confidence back in the market, and we like to see that. But we're not completely back to the level of 2021.
Pierre-Antoine, great having you in here. Thanks so much. Fascinating market. Pierre-Antoine Desalency of 17 Capital. Coming up, the market-moving events you need to be watching today. That's next in our trading diary. This is Bloomberg.
answers, great questions.
Time now for the Trading Diary. What you need to be watching this week. The FOMC minutes coming at 2 p.m. Eastern. Very important to see how the Fed thought about this most recent data, followed by NVIDIA earnings after the closing bell, an earnings report that literally everybody who's invested in equities is going to be watching. Thursday, we get initial jobless claims as well as PMIs for the United States of America. Plus, Atlanta Fed President Raphael Bostic speaks. And then finally, on Friday, we'll get University of Michigan sentiment. So we'll see what the consumer thinks of this economy. This was the Countdown to the Open. I'm Matt Miller. This is Bloomberg.
We are 30 minutes into the U.S. trading day on this Wednesday, May 22nd. Here are the top stories we're following. Moment of truth. All eyes on NVIDIA earnings after the bell today. Investors eager to hear about the state of AI spending. The bar, of course, very high with NVIDIA shares up 93% year to date. Reinsurance, so hot right now. Manulife CEO Roy Gori, he joins me in an exclusive interview to discuss the firm's recent reinsurance deals and the firm's expansion in Asia, with the region's profit contribution expected to climb to 50% by 2027. And Ares aiming for $750 billion. Fresh off the firm's investor day, Ares CEO Mike Arrighetti joins for an exclusive conversation about AUM goals, the growth of private credit, and how AI could change the industry. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at the board behind me. Another quiet day, but it is green, at least for right now. You take a look at the S&P 500, currently unchanged. Of course, a little bit better if you take a look at big tech, with the NASDAQ 100 higher by about 0.2%. And then you take a look at the Philadelphia Semiconductor Index, currently higher by about 1%. But everything could change this afternoon with, of course, NVIDIA due to report earnings. And it really feels like, of course, the whole market is resting on the chip makers' shoulders. But before we get there, let's get to some breaking news in the last couple of minutes, and that is Anglo American agreeing to enter talks with its larger rival BHP. That's after it rejected its third proposal worth $49 billion. Now, this, of course, opens the door to what could be the biggest mining deal in over a decade. Will Kennedy, he is Bloomberg's senior executive editor for energy and commodities, is here with the latest. So the door is open to talks, but is there a chance here that we could see BHP walk away?
I think there's every chance. BHP has said that as it stands, this is its final offer, although there is probably some wiggle room if there is an agreed deal eventually with Anglo. But for now, they say this is their best and final offer. Interestingly, Anglo have removed the language in their latest statement saying the offer undervalues the company, which suggests that the valuations may be coming close together. But it says that it still rejects this complicated structure that BHP has proposed on demerging two South African units before the merger can go ahead. So that seems to be where the sticking point is at this stage.
So we'll, of course, see if that really was their final offer. But let's get to the heart of the matter here, Will. Is this really just all about copper?
That's the strategy here for BHP. The reason they're pursuing Anglo American so hard while they've made 3 different offers to buy this company is because it sees copper as the opportunity for growth. It wants to rebalance its portfolio away from its reliance currently on iron ore towards copper, which people think is the metal for the energy transition, and that demand is going to outstrip supply in coming years. And by buying Anglo American, which has a very strong position in the Andes, in Chile, and combining it with BHP's existing copper business, they would control 10% of the market.
All right, well, who knew that the mining industry could be so dramatic, so interesting? Our thanks, of course, to Bloomberg's Will Kennedy. And let's turn to the broader markets now, because joining us now, we have David Miller. He is Catalyst Capital co-founder, CIO, and senior portfolio manager, sitting to my left. Great to see you in person.
Great to be here.
Let's talk about where we are right now, of course. We're at the S&P 500. We're at all-time highs. We have the likes of NVIDIA reporting after the bell today, and it feels like the last few quarters, this comical thing has emerged where it's all about NVIDIA. This is the most consequential thing that could ever happen. Are we over-egging it? Should we calm down a little bit?
Well, I mean, part of the question is, what are we really expecting from NVIDIA? You know, people are looking to about $5.59 a share. If you look at all of the past 4 quarters, they've all been beats. The average beat has been about 13%. So it seems like the street is sandbagging things a bit, and more likely than not, the whisper numbers are a good bit higher than that. You know, the option markets are pricing in like an 8% likely move. So, you know, it's momentous, but does it drive everything? No. Clearly, the AI revolution and that huge buildup in the arms race for AI and getting those Blackwell chips is a bit isolated from the rest of the economy.
It's a good point. And to your point on the options market, some great coverage on the terminal right now that the options market, in terms of what it's been pricing in for post-earnings moves, specifically for NVIDIA, hasn't been too correct over the last few quarters. But when you zoom out and you look at the broader market, of course, we're really at the tail end of earnings season. We do have some big names left, but now we're sitting just on the cups, pretty much all there at all-time highs. What's next? I mean, you think about the Fed and how we entered the year with, 6 cuts priced in? Now we're down to 2, and it seems like the market says that doesn't actually really matter. What are you thinking about the interaction between the micro and the macro?
Well, when you look at the macro, I think the most important driving factor over the long term is U.S. government deficits. And they're currently running about $1.5 trillion. It doesn't seem to matter too much which party wins. Those are likely to persist. So that creates a bit of a crowding effect in debt markets. And it's very hard to see how we could get meaningfully lower interest rates as long as unemployment data is pretty low, these CPI prints are fairly high, and the government keeps borrowing at this pace. So I think more likely than not, we're going to see higher for longer.
Higher for longer on interest rates. And that actually leads me to a question I've been wondering about. Typically, we talk about just stocks on this show, but I actually want to talk about the yield curve, and I want to talk about the 2-10 spread because it just seems like the steepener was one of the big trades coming into maybe last year and then again into this year. It's gone nowhere. We've been hovering around negative 40 basis points for several months now, really since the end of September or so. Is the steepener dead?
I don't think it's dead. I don't think it'll be very interesting. Obviously, it's kind of an interesting concept that you can actually short bonds and get paid to be short bonds when you have an inverted yield curve. But unless federal government policy changes and we go into some type of austerity mode, I don't really see how we're going to get out of that inverted yield curve anytime in the really near future, unless, of course, the economy starts to change more materially and CPI prints start to decay.
Well, you think about the front end, leaving behind the back end, but the front end, which is so sensitive, of course, to Federal Reserve policy, have we seen the pricing in of those rate cuts already happen? I'm just wondering when we think about what could make the steepener more interesting. It doesn't feel like it's going to come from the front end.
Yeah, no, it doesn't really seem like it's going to come from the front end. But yes, I mean, I think things are somewhat priced in to some extent, and maybe the market doesn't really think we're going to get 2 cuts. I think it might be more of the driving issue.
And so let's bring this back, of course, to the equity market, this idea of higher for longer. We've talked about a little bit what it would mean for the bond market, but for the equity market, how does that inform picking and choosing stocks? I mean, how does you overlay that into a company's actual fundamentals?
Sure. Well, when you think about inflation and how it impacts a company, there's some companies where inflation is amazing, and there's other companies where inflation is a big negative. And that's where we have much more of a stock picker's market now, because those companies that have exceptionally high margins, that have tailwinds in their business, that have monopolistic or oligopolistic type positions, companies like Visa, MasterCard, Google, Microsoft, in those cases, inflation is great. Now, I mean, it's not great when you look at the denominator factor for the higher interest rate component, but for their underlying businesses, it's very good because they can pass through those inflationary costs and then some. And then you have those companies with very high input costs, like airlines, where they have to deal with both higher commodity costs and higher staffing costs. Huge negative for firms that are in that more type of perfect competitive mode.
And is that really the framework that you're using to look at the stock market? Is it just still about inflation being one of the dominant things that you're looking at?
Sure. Well, when I'm looking at the stock market, inflation is obviously very important, but you really have 2 different stock markets the way I look at it. I think Peter Thiel had a great quote about monopolies, and when you really think about it, those businesses that actually drive the earnings of the S&P 500 and the total returns of the S&P 500, it's a very small percentage of companies that do that. And it's those companies that not just win, but win the whole thing that make those huge impacts. It's those companies like Google, like NVIDIA, like Microsoft, like Visa, like MasterCard that gain global dominance with massive margins. And those are the companies that make things work. So I'm trying to focus on who are those winners.
And when you think about that, I hear what you're saying. I mean, those are the dominant monopolies, if you want to call them that. But then you think about the bear case, and it would be valuation. Someone would bring up valuations and say, yeah, they're also really expensive. I mean, how do you square that circle?
Well, I guess the way you square it is you say, okay, well, what are they actually worth 10 years from now? And if you think about it, a company like Visa or MasterCard, I don't really see the bear case. Like, you'd have to have a deflation in order for their revenue to not grow significantly. That revenue, assuming it increases, has to flow down significantly to the bottom line. So I think when you look at it, if a company actually is a real monopoly with massive margins, that company is objectively worth orders of magnitude more than a company that really has to go head-to-head with their competitors where their products are basically the same as what everybody else is doing and can be easily replaced.
It's a fair point, too. And if we are entering into a period of deflation, if we were to do that, then we have much bigger problems on our hands. David, it's great to see you. I really appreciate your time today. That, of course, is David Miller of Catalyst Capital. And let's actually zoom in and take a look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Bailey Lipschultz. And Bailey, we have to talk about NVIDIA.
We have to, Katie. As you and David mentioned, markets pricing in about an 8% move. You made the point that those options implied moves have not been that right over the last few quarters, but nonetheless, it should be plenty of fireworks after the bell today. All eyes on whether or not they can continue to grow their activity in data centers and continue to see the massive numbers that we've been seeing over the last, call it, year and a half at this point. Katie, when you look at the performance for the S&P 500, NVIDIA accounting for about a quarter of its year-to-date gains, so all eyes on a stock that's up, what, 78%, I think the last I checked year-to-date, maybe 92, something like that. I don't have the terminal in front of me.
Let me tell you what it is, because last I checked, it was 93%.
Okay.
But the point remains, it's up a lot.
Yeah.
Tell me about Target, because right now it's down a lot.
I was going to say Target down a lot, worst day since late 2022. Underwhelming results, underwhelming comp sales, comparable sales falling for the fourth consecutive quarter, missing expectations. Analysts really saying that right now when you look at the results, not really much of a reason to step in and want to buy the stock. That's why you're seeing it under pressure again today. Sharp move lower. This is a company, again, centered kind of on the consumer sentiment and consumers' ability to spend. They did call out on their earnings call that consumers are tapering some of their spending on goods and instead paying up for services, and that's actually impacting their bottom line. One thing to keep in mind and keep an eye on is they did announce thousands of items will see price cuts throughout the summer. So following in the footsteps of McDonald's with their $5 value meal that they're unveiling, continuing to try to keep consumers back to their stores. But it is an interesting thing to keep an eye on, just given Target, to me at least, has been one of those bellwethers in terms of a good look at how the U.S. consumer is faring.
Yeah, it makes sense that they're trying to really boost sales by boosting incentives. Stock currently down by the most since November 2022. And bring it home, because it's also an ugly story for Lululemon.
Ugly story for Lululemon. When you look at the year-to-date performance, it's pretty ugly. Continuing to see a shift down and to the right, which you obviously don't want right now. One of the worst days in 2024, this coming after their chief product officer departed. Company did say that Chief Product Officer Sun Cho was leaving the company without being replaced. Raymond James saying that that adds to the wall of worry for the company. So this is Lululemon is dealing with heightened competition, dealing with some of those valuation concerns, similar to Target. Consumers kind of pulling back some of the spending on what I would call is slightly overpriced leggings. I do buy them for my fiance, but nonetheless, Katie, it does seem like there are a number of clouds, and again, as Raymond James put it, a wall of worries and a number of concerns for investors and sell-side analysts around Lululemon. That's why you're seeing it continue to lag this year and really adding those losses here in 2024.
Billy, they have a men's section. They have great pants.
I know, but I'm cheap, Katie. I go to Target and buy things for $4.99. I don't really spend 60 or 70 bucks, though I have heard they're very comfortable.
They are very comfortable, speaking from my husband's experience. But anyway, let's end it here. Bloomberg's Bailey Lipschultz. Really appreciate that roundup, as always. Now, coming up, Roy Gorey. He is the president and CEO of Manulife. He joins us to talk about what's next for the insurance giant. This is Bloomberg. All right, well, one stock we are watching is the Canadian insurance giant Manulife Financial. The stock is off to a hot start this year. It's outpacing the S&P by a wide margin. And here now to talk about the landscape for the insurance market, I'm pleased to say we have Roy Gorey. He is Manulife President and CEO, joining us for an exclusive conversation. So I'm looking through the notes, and you have been calling this a transformation, 2023, a transformational year. Your stock is at the highest level since about 2008. Is it still a transformation?
It is still a transformation. Firstly, it's great to be here with you, Katie. And, you know, for our company, we've been on a journey of transformation since 2017. We said we wanted to be the most digital customer-centric company in our industry. But at the same time, we knew we had to de-risk our business and improve our returns. Over the last 6 years, we've increased our return on equity from about 11% to 16%. We've divested a lot of low ROE businesses, and we've also digitized our franchise. So we're really pleased with the progress that we've made, and 23 was certainly a milestone year for us. We achieved great operating results. Our core earnings per share grew by 17%, double-digit growth in our sales metrics, and we delivered positive net flows from our wealth and asset management franchise. Q1 was a nice momentum follow-on from 2023. But you're right, you know, I think organizations like ours don't ever stop transforming. I think as I look to the decade ahead, there's still a lot of opportunity for us, and we need to continue to look for ways to advance our agenda and deliver great value for not just customers, but also for shareholders.
Well, let's get into some of that, particularly in reinsurance. So you've done several deals over the past couple of months, but just to set the scene, the way I think about reinsurance is basically insurance for insurance companies. Is that a fair description?
I think that's right. So insurance companies will reduce their risk by either reinsuring them or divesting blocks. And again, for us, a big priority for us over the last 6 years has been reinsurance or divestitures. We freed up $11 billion worth of capital, which has been a key part of how we've actually improved our return on equity and reduced our risk profile. And we work with partners that either take the business off our books or who reinsure the business and basically take on the risk associated with it.
Well, you've been particularly active when it comes to long-term care, actually. It looks like you've reduced your exposure to long-term care and variable annuities through reinsurance to 11% from 24% from 2017, which is also the year that you took over as CEO. Do you think that there's more deals there? Are you going to pursue more long-term care reinsurance deals to further exit that business?
Yes, is the short answer. In 23, we did a milestone historic long-term care deal. There weren't many deals ever done before our transaction, and it was the largest ever in history. So it was an important signal to the market that long-term care is transactable, and for us to have been able to trade the book pretty close to our book value sent a really positive message to the market. And as a result of that, there are now many more interested parties who are coming to talk to us about other parts of our long-term care portfolio that they may want to acquire or take on from us. So we think it was a good first step. We traded at a really very attractive price, but we think that there's further opportunity.
So inbound offers you're receiving, you're not just soliciting bids, so to speak.
Yeah, so there are people that are, or companies that are interested in talking to us about our long-term care portfolio, and we're certainly engaging in conversations with them.
So if your exposure is about 11% right now, do you have a specific target in mind for where you'd like to get to?
We wanted to get our long-term care and variable annuity, which were the more problematic parts of our portfolio, significantly reduced. And as you rightly point out, they represented about 24% of our earnings in 2017 and now down to approximately 11%. We think, as we naturally grow our business, that percentage will continue to decrease. But if we can transact, then that will be a quicker way for us to actually get down to certainly less than 10%.
So that's the state of reinsurance and long-term care. Let's also talk about Asia, because you think about your recent earnings report. I think a lot of the street was pleasantly surprised by the growth in Asia. Bloomberg Intelligence actually expects that the region's profit contribution could be 50% by 2027. How do you expand distribution in Asia? What does that look like?
Yeah. Well, we're really proud of our Asia franchise. It's one of the things that really differentiates us from our peers. We've got such a strong presence in Asia that complements our North America capabilities, both in Canada and in the US. And again, having a diversified business across 3 broad geographies is a significant advantage, certainly in an environment where we're seeing GDP growth in North America slow a little bit and Asia continue to grow at 4 to 5%. We were the 6th largest Pan-Asian player many years ago, and now we're a top 3 player, and you need to be a top 3 player to grow and to have credibility in that part of the world. Now, we've been in Asia for more than 125 years, so we've got a strong brand and presence there. We've got a strong distribution capability with about 100,000 agents, but also 10 bancassurance partners that we work with to sell our insurance products. So for us, distribution is really key. Presence and a brand also matters, but we're very optimistic about the outlook for our business in Asia.
I have to say, bancassurance was a new vocab word for me as I was preparing for this interview. But before I let you go, I do want to talk about wealth and asset management, obviously an area of focus for you. I know you recently closed a deal to acquire CQS, and I'm wondering, when you think about growing that side of the business, are you trying to do that through more acquisitions or through organic growth?
Yeah, that's a great question. Our wealth and asset management business has been a really big priority and focus for us. Again, we're quite unique in that we're geographically diverse, but we're also business diverse in that we're not just a retail shop. We have an institutional capability, but we also have a retirement capability. And with a world where the population is constantly aging and there is a huge retirement gap, that really positions us really very well to capture business growth and momentum. So for us, growth will happen organically because we're in parts of the world where our products are in huge demand and need, but there's also an opportunity to put our capital to work, and we're very well capitalized. So investing in businesses like CQS that add to our capabilities is another way that we're going to grow beyond the organic opportunity that we've got.
Well, given the share performance, it seems like you certainly have some money to spend. But Roy, unfortunately, we have to leave it there. Hope to see you again soon. Our thanks, of course, to Roy Gorey of Manulife. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, BuzzFeed making a big social buzz after news that former U.S. presidential candidate Vivek Ramaswamy is taking a stake in the struggling online media company. Ramaswamy, of course, ended his candidacy in January through his support behind Donald Trump. And this purchase makes him the 4th largest shareholder in BuzzFeed. Finally, we have Venus Williams is a Barbie girl, literally. The tennis superstar has been transformed transformed into a Barbie doll along with 8 other female athletes as part of a new project by Mattel that aims to encourage girls to stay in sports. The one-of-a-kind role model dolls are in the spotlight ahead of the Paris Olympics that kicks off this summer. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now coming up, Ares Management aims to surpass $750 billion in assets within the next 4 years. We speak to Ares CEO Michael Arrighetti next. This is Bloomberg. Well, Ares unveiling a number of new targets. The asset management firm predicting it will boost assets under management to $750 billion by 2028. In a statement posted on the company's website, it said, quote, "We expect to grow faster than the projected industry average over the next 5 years." For more, I'm pleased to say we're joined now by Mike Arrighetti. He is Ares CEO and, of course, Bloomberg's own Sonali Basak. So, Mike, let's start, of course, with that target. I have to imagine that the growth of private credit is an important ingredient.
It is a big driver, and obviously it's a big part of what we do. But if you look over the last 5 years, when we gave our prior guidance, we said that we were going to grow 20%. We grew 35%. Private credit was a big part of that. But we've diversified into other big growth areas like real assets, private equity, secondaries, insurance. So I think it's a combination of all of the above.
How do you think about the private credit market writ large here? You've had so many new entrants. You have billions of dollars flowing into the industry. A lot of investors are looking around now and asking, where's the risk?
Well, you have to. Everyone defines private credit differently. So when we talk about private credit today, I think a lot of people are specifically talking about corporate direct lending in the U.S., which is a great market. It's a market that we've led for many, many years, and it is a market that, frankly, in my opinion, is still undercapitalized. And we can come back to that maybe. But when I think about private credit, we're talking about all self-originated private credit, rated, non-rated, or ratings equivalent in corporate, real estate, infrastructure, asset-backed, opportunistic. So these are huge addressable markets, each of which is growing at a very high rate for structural reasons. So we're not really experiencing the market as crowded. And when you look at the performance in the underlying portfolios, we're not actually seeing risk emerging in any of those corners.
Well, that touches on something that I've been wondering about. Of course, with the growth of private credit, like Sonali mentioned, all the new entrants, what does deployment look like when it comes to the actual opportunities there to throw money at?
Well, here's something to think about. If you look at fundraising in the private credit market, over the last 5 years, the top 25 managers, we're at the top of the list, grew the fund to 56% market share in capital raised. Okay, so 60% of the dollars are going to a very small handful of people. The 5 years prior, it was roughly half that. So these markets are growing, but they're also consolidating. And so while you're seeing a proliferation of funds, the way that capital is getting raised and deployed, it still sits with a very small handful of people. So if you look at our deployment, we put out about $40 billion a year in our private credit franchise. And that's been consistent for the last 3, 4, 5 years, regardless of the rate environment, regardless of the competitive environment.
Mike, as we sit here with you today, it's interesting. A lot of investors have a lot of AI on their minds with NVIDIA after the bell. And I've got to say, in your Investor Day, you did say the buzzword. How is AI going to drive the future of private credit?
It's still early. And so we've known each other a long time. And whenever something as transformational as AI comes out, we want to make sure that we first understand the opportunity. We want to understand the risk, and then deploy in a measured way, but we can't ignore it. My view is, at least for private markets investors, the biggest opportunity in AI will be twofold. One, supporting the digital infrastructure necessary and needed to see the data explosion happen, and that's everything from data centers, renewable power, grid transmission. So that's one big theme. That market is undercapitalized. We're leaning in there. And then two is, how do we use AI to improve the efficiency and the returns in our own company and in our investment portfolio? We recently made a small acquisition of a team of technologists, Bootstrap Labs. We have put them into our corporate strategy group, and we're now deploying them into our portfolio to look for opportunities for efficiency. We're deploying them into our middle and back office to try to drive margin expansion, and we're eventually going to set them free on our portfolio companies and data to try to create some underwriting edge. So I think that's going to be the long-term holy grail.
To this holy grail, if you look to this kind of long-term push that you're making here to 2028, adding assets under management, then where do you look to deploy your own capital? Not the funds, but investing in the business. Is it the marginal hire, or is it the marginal technology expertise here?
It's both. It's both. But we've been very vocal that I think the strategy to win long-term in private markets is origination and investment acumen. Now, we're going to be able to use technology to support good investment decision-making. Any margin enhancement that we can generate through technology, we're going to put back into the investment engine, right? Because when you're in these large addressable markets, ultimately we win by finding investment opportunities that others can't. And at the end of the day, technology can't do that alone. So my own way of thinking about AI is it is a supplementation of our human capital. It's not a replacement of our human capital.
Well, overall, how are you thinking about your human capital? When you think about some of your AUM goals, for example, do you plan to hire more people to help achieve that?
And how many?
I'm going to say yes, plenty, and then I'm going to get back and my phone's going to be ringing off the hook with people looking for a job. Yeah, clearly. If you look at our headcount, we have 3,000 employees at Ares today in 40 offices in 20 countries. They're all growing because, again, our differentiator is our ability to be in these local markets, developing relationships with companies and assets. So by definition, we have to grow our headcount in order to support the AUM target, and I think we'll be doing that all over the globe.
Now, there are some areas that have gotten really hot in private credit. One where you guys have made an early splash is sports.
Yes.
There's a lot of news around the market about the NFL looking to be open to private equity ownership. How big is that market? Is it even attractive to somebody like you?
Yeah, I think the sports, media, and entertainment, as I would describe the opportunity, is a huge addressable market. We formally entered the business about 4 years ago in the middle of COVID, identifying that would be a catalyst for what we thought would be transformational change. So when I reflect back on our 30 years in private credit, it's always been about innovating where there was some form of rigidity in the way that things got financed. And if you look at sports globally, they've typically been financed with bank capital and high net worth investors and nothing in between. Right, and what we've learned over 30 years is the markets will evolve to, value innovation in capital structures, and I think that's what's happening in sports. So the NFL being one example of many, as these leagues are maturing and people are seeing values grow, they're bringing institutional capital in to unlock value in the capital structure, support growth, bring management expertise to the table to help drive continued revenue. So I think we're just getting started. And this is a TAM that did not exist. So you mentioned the NFL. If you say 30 teams times, 3, 4, 5 billion, pick your number, one league alone, you can see you start to create $100 billion equity TAM. And so I think we're just beginning to see the evolution of this, but it's going to open up a whole new market investment opportunity for folks like us.
I also do want to talk about wealth, because obviously that's a big growth driver for you. How do you keep the momentum going? How do you continue to expand in your business, in that business?
Yeah, I think, look, there's going to be, like all things in our business now, it's consolidating, and the consolidation is accelerating. I think in wealth you win with people, i.e. you need teams around the globe that are supporting the sales and servicing of the wealth investor. You need a platform to support it. You need product. You need track record, you need relationships with the distribution partners, and it's a huge investment. We have 125 people with 6 products that are actually pushing product into the wealth channel. We said at our investor day yesterday, we expect our $25 billion today to grow to $100 billion. We expect our 125 people to go to 175, and our product set will go from 6 to likely 10. So again, you have to make investments in each of these areas: people, product, platform,
these
etc.
are long-term goals. 2028, you set these goals for. But what about the next 12 months? What's the biggest opportunity?
I think we just got to keep doing what we're doing. Obviously the transaction market is beginning to open up. Deployment is starting to pick up again. The fundraising machine has been working for us, as you've seen in our fundraising numbers, in what we, by all accounts, here is a difficult fundraising market. So I think every year is about execution. The way that we got to our 5-year goals is just, keep doing what we're doing, and I think that's what we're focused on.
Well, Mike, I think that's a good place to leave it. Really appreciate your time today.
Appreciate
that, of course, is Mike Arrighetti of Ares, and of course, Bloomberg's Sonali Basak. Let's get a check on these markets now. Of course, about an hour into the U.S. trading day, we're going to do that with Bloomberg's Abigail Doolittle.
And Katie, we continue to be in this period of time where stocks are simply treading water. The S&P 500 up ever so slightly. In fact, over the last 5 days so far, we have not seen a move greater than 0.25% to the upside or to the downside. The sleepiest stretch in more than 5 years for the S&P 500. And of course, it has everything to do with NVIDIA. Investors waiting to see what kind of numbers they will put up. And more importantly, will the guide be a blowout again? On the year, if we take a look at the S&P 500, the NASDAQ 100, we're going to see nice numbers higher, up about 12%. The stocks up 23%. Take a look at NVIDIA. It's almost ridiculous. Year to date, we're not even halfway through, up 91% after this stock gained about about 238% last year. Valuation is not outrageous. We're at about 29.5 times forward earnings. That's at the lower end of their range. Some other valuation metrics are a little bit rich, but again, it's going to come down to whether or not they can continue to guide significantly higher on the AI potential. Let's take a look at the stocks relative to the S&P 500. This is very, very interesting. That peak all the way to the left, that is in the tech bubble. The Philadelphia Semiconductor Index relative to the S&P 500. Back in March, the stocks briefly put in an all-time high, but more recently we have not seen that. So essentially you have the broader indexes putting all-time high, chips hanging back a little bit. Not sure exactly how that divergence will play out, but you can see that that resistance there is pretty strong. It'll, of course, have a lot to do with how NVIDIA plays out in terms of the earnings after the bell. And then let's take a look at why it matters so much to the S&P 500 this year. As we just saw, the S&P 500 up more than 11% on the year. Almost 25% of that gain has to do with NVIDIA. And then we're looking at the other big tech names, Alphabet, Microsoft, Amazon, and Meta rounding it out, Katie.
All right, so a lot to look forward to after the bell today. Our thanks, of course, to Bloomberg's Abigail Doolittle. Now coming up, Nobel Prize-winning economist Paul Krugman. He weighs in on how markets will react to the 2024 race for the White House. This is Bloomberg. All right, it's time now for our Wall Street Week conversation. And today, we're looking at the impact of a Trump or a Biden presidency on the U.S. economy. Wall Street Week's David Weston spoke with Paul Krugman. He is Nobel Prize-winning economist and New York Times columnist about the economic choices that voters should consider before heading to the polls.
It doesn't look as if it has made a whole lot of difference who's in the White House. But if there's a Trump too, then there's a lot of reasons to believe that it could be very different. What's amazing if you go back and look at Trump's first time in the White House was how little he did when all is said and done. Basically he got a moderate-sized tax cut through, sort of. Period. End of story. There wasn't a lot else that went on. That's largely because there were institutional restraints. There were, they couldn't get stuff through Congress, couldn't tell the Federal Reserve what to do. That could be very, very different right now. And if you take seriously what Trump, former Trump aides are saying, it would be very, very drastic. I mean, Biden would do continuity. Biden, if he can do it, will do more, some further tax increases, some more green industrial policy, but probably not enough to make a huge difference to the macroeconomic numbers. Big differences in other respects. Trump, well, we know that one of his former aides has been talking a lot about rounding up millions of immigrants, supposedly undocumented, though it wouldn't be surprising if a lot of legal immigrants got caught up in the net as well and deporting. Huge economic impacts, huge disruptions to the labor force. Another, Peter Navarro, who's being interviewed from jail, but has said that Jay Powell will be fired within 100 days. And that we will basically have the politicization of monetary policy. And there's a lot of reasons to think that a Trump second term might see him become one of those autocrats who demands that you run the printing presses for his political gain. I mean, think of Erdogan in Turkey or something like that. It's huge uncertainty, but I think anyone assuming that a second Trump term would look like the first one with what ended up being fairly conventional economic policies, nothing, and the Federal Reserve keeping a lid on things, could be in for a very rude shock.
Picking up on your comment about monetary policy and Fed Chair Jay Powell, we had Ken Rogoff on, somebody you know well, a fellow economist. Yeah. And when I asked that question of him, he said the markets would not let new President Trump do that they would react really strong in the Treasury markets, and he would not have that option. Is that plausible?
The markets would certainly react. We would probably see acceleration of inflation, a plunge in the dollar, but, how does he respond to that? I mean, again, if you look at much smaller countries that are much more exposed to market pressure, like Turkey, authoritarian leaders have a habit of saying, well, the markets are wrong, and I'm going to order them to stop. You might be surprised at how much socialism, or at least in the sense of capital controls and other things that might happen. If Trump says to the Fed, I want a booming economy, I want you to roll the printing presses, and the markets respond by driving the dollar down and inflation up, he might well then say, well, I'm going to put on rules that stop that from happening rather than changing the policy. Remember, we've had one, since the immediate aftermath of World War II, we've had only one episode of price controls in America, and it was Richard Nixon, not some progressive Democrat who did it. So I think you want to be, I understand Ken's point. He thinks that the bond vigilantes basically would discipline Trump, but I don't think that's a safe bet.
What about the prospect of inflation? Obviously, tariffs tend to be inflationary rather than disinflationary. At the same time, both President Biden and former President Trump seem to like tariffs pretty well.
Well, there's a big difference. I mean, yes, both are doing tariffs, and Biden has not rolled back most of the Trump tariffs, which doesn't want to be accused of being soft on China or something like that. But if you look at the new proposals, they're actually, although they both are proposing tariffs, they're very different both in the details and in the purpose.
And that, of course, was Nobel Prize-winning economist Paul Krugman, and, of course, Wall Street Week host David Weston, who joins me now. And it was a good reminder that, of course, a second-term Donald Trump, he could have much different economic policies than first-term Donald Trump.
Yeah, exactly. We don't know exactly what it would be. There are a lot of reports coming out, although we haven't actually heard from Donald Trump himself what he's planning on doing. And you can probably tell Dr. Krugman has a point of view on who he thinks might be better for the economy. He's made that clear in the interview, but also in his columns in the New York Times. And one of the things that he tends to leave out, and we asked him about it some, what about deregulation? Because a lot of people who support former President Trump becoming President Trump once again say, well, if we had deregulation, we'd get a lot better economic growth, Katie.
And I mean, it's interesting, of course, when you think about the Fed, for example, beyond just what the actual president may enact. There's been a lot of reports about what Donald Trump would mean for the Fed and the choices he might make there.
Well, there was that one Wall Street Journal report, right, that came out. It did not come directly, as I say, from former President Trump. And in fact, if anything, they distanced themselves from it. So it's a little hard to know whether that's just people making it up, people trying to influence Donald Trump, or whether it was a trial balloon. It's hard to know. And also, there are some legal constraints as well. I mean, there is a law that governs the Fed, and that does not give the president power to dismiss the chair other than for cause. So it's not clear. And if we look back to the first Trump administration, as much as he wanted to do some things, there were other institutions that constrained him in various ways.
That's true. It's a good point there as well, that there's laws, and those might come into play here if we did see something. Of course, to your point, we haven't actually heard directly from Trump's camp. Let's talk about the markets, though, a little bit, because again, we know what a Biden presidency looks like. We know what Trump first term looks like. How might the markets react?
Well, remember what happened with the first Trump, because the markets really fell precipitously there at the beginning, and then they came right back. And over